right, we're in Module 3 and the key takeaways. This module covered the shareholders' equity and then moved on to financial statements generally and then SEC reporting requirements. There's a summary of Mod 3 in my courses, and it's a more extensive coverage than what we're going to cover in this presentation. Module 3 covered 4 topics: shareholders' equity and cash flow from the first course of Financial Accounting Advanced Topics. And then topic 3 was financial statements and GAAP. And topic 4 was introduction to SEC filings. Topic 1 is shareholders' equity. And this represents the amount of money either put in through share purchases or kept in the company through retained earnings over the life of the company in order to have some of the money from the company to match with the money that they could obtain from lending sources, which is what we call leverage. Shareholders' equity is the owner's money, is one way to think about it. The learning objectives were: what are the 3 factors that affect shareholders' equity? What is the importance of common shares? And how to do accounting for share issuances, dividend payments, and share repurchases. The key takeaways for shareholders' equity as far as terminology are common share, shareholder, par value, additional paid-in capital, retained earnings, dividends, treasury stock, voting rights, authorized shares, outstanding shares, and issued shares. If those are clear and you know the distinction between those items like authorized, outstanding, and issued, you're good to go. If not, you know what you need to do. Go back and review it to make sure your foundations are solid. The knowledge and skills are answering these questions. What factors can change shareholders' equity? Or how do we do accounting for share issuances? And what is a common share? And what are some of the features of common shares? How do you account for dividends? And how do you account for stock repurchases? Basic stock terminology. Authorized shares are from the incorporation filings to the state at the outset of the company. It is the maximum number of shares that the company can issue. It can expand this with a later filing, but at that moment is the amount that was approved. Note that the company is not required to issue all these shares. It's just a maximum. Second is issued shares. These are the number of shares that were actually sold by the company to investors. Imagine a book of shares that you can sell. How many of those pages or stock certificates did you sell? That's issued. Third is treasury shares. These are company repurchases of their own shares, and now they're held in treasury, which means they control the shares in the company. They're not retired. They're kept as issued shares, but they're no longer outstanding. Outstanding shares is equal to the issued minus the treasury shares. This represents how many shares are held outside of the company. Par value is similar to authorized share above. It's the value of the shares as established by the incorporation papers when the company first started out. And subsequently, it's modified when the company splits some shares. We'll see more of this later. And the last is market value. It's the value of each share for purposes of buying and selling on the open market. It does not bear a direct relationship with the accounting statements. It's what is in the minds of the purchasers of the shares. It's determined by many other factors other than the financial statements themselves. And it looks at what is the future of the company, and therefore what is the value of the stock. Some typical equity transactions we'll go through here using the template. And the first example is an investment from an outside investor to the company. The cash comes into the company and the stock is issued to the investor. In this example, right here, we have $25,000 paid for 10,000 shares with a $1 par value. The first part's easy. You'll find that the easy part's always the cash. We got $25,000 cash plus $25,000. Next, we say the common stock goes up based on the number of shares issued times the par value. 10,000 times 1 is 10,000, and the difference between the cash, 25,000, and the common stock value of 10,000 at par is 15,000, and that's called additional paid-in capital. Sometimes it's called additional paid-in capital in excess of par. That's very explicit on how it's determined. The second transaction is all income is in retained earnings, and therefore that's how it connects to the financial statements. And here we see an example is if we had $75,000 worth of income, it jumps over from the green area of income statement to the blue area of the balance sheet as a positive to retained earnings. If it were a loss on the income statement side, it would then be simply a minus in retained earnings. The next item is a dividend. Cash dividends are declared by the board of directors and paid to common shareholders. Sometimes you break those into two transactions. One is they declare a dividend, which sets an obligation, and then a month or so later, they'll pay the dividend. That is broken into two transactions. But in this case, we'll just make it easy and say they declared and paid immediately the dividend. In that case, we had a negative 10,000 of what's paid because $1 per share times 10,000 shares outstanding is 10,000, and that is a reduction of retained earnings. Fourth is a repurchase. The company repurchases shares and holds them in treasury. In this case, we repurchase 100 shares times 150 per share equals 15,000 out of cash, and it goes as a negative in the shareholders equity section in an account called treasury shares as a negative 15,000. The last item is a stock dividend, which is declared by the board, and we give shares to common shareholders. We provide a small stock dividend of 1,000 shares, and the market value of those shares is 20. What we do is say, okay, what is the value of the shares we just gave? Times 1,000 shares is $20,000. We treat that as if it were a cash dividend paying out, a negative to retained earnings, but instead of paying cash, we show that we gave 1,000 shares, and at par, that's $1,000, and we show that we got 19,000 in additional paid-in capital. That's this transaction. All right. Next, we look at General Electric. They're a $21 billion company in terms of equity. And where is that equity? We see that they have a little bit of preferred stock, but most of it is in common stock, and the vast amount of it is in retained earnings. Because General Electric has been around for over 100 years, they've made a lot of money in that period of time, and some major item that contributes to their shareholders' equity is actually the retained earnings. Notice that they also have $81 billion in treasury shares. They've done stock buybacks over the years as well. Topic 2 is cash flow statement. And this is one of the most important statements. It's actually one of my favorite statements because I could tell a lot about the company and how it's run based on the cash flow statements. And that's because it's looking at 3 activities and helps dissect the business in those activities. Those being operating, investing, and financing. You look at the cash flow statement, and then you look at the sections of the cash flow statement. It tells you a lot about how much cash is being made just from running the company. And then what did they do with that cash? Did they invest it? And if so, in what? And then they looked at the financing. Are they borrowing money? Are they paying back money? Are they issuing shares? Are they buying back shares? All this is exposed in a pretty easy to read way on the cash flow statement. The learning objectives are differentiating between net income and cash flow, appreciating how investors can use it, similar to what I just described, and then constructing a cash flow statement, and then look at possibilities of earnings management. The key takeaways are terminology such as, okay, listen and get ready to tick off, cash flows, earnings management, cash flow from operations, cash flows from investing activities, cash flow from financing activities, liquidity, earnings quality. And as far as questions regarding knowledge and skills, what is the difference between net income and cash flow? How can investors use cash flows to make informed decisions? How can investors use cash flows to uncover potential earnings management? And how is cash flow from operations constructed? Or how is cash flow from investing section constructed? And finally, how is cash flow from financing activities constructed? This is a colorful slide because the colors mean something. We're looking at now those 3 activities I referred to earlier of operating, investing, and financing. We'll start with operating. This represents the cash that was generated or used from running the business. We start with the green, which is net income. We always start there. This ties the cash flow statement to the income statement. Then we make adjustments for non-cash items. One example that is on almost every company is depreciation. Depreciation is a non-cash expense. Therefore, it does affect net income because it is a non-cash expense. However, it is added back to the net income when we're now looking at cash flow from operations. We add back depreciation to net income. The next items, which are in yellow, are the changes in operating assets and liabilities that occur during the period in which the reporting is done. And it leads to things like when an asset goes down, that means you're generating cash. If an asset goes up, that means you're using cash to buy those assets. If a liability goes down, that means you're using cash to pay off liabilities. But if liabilities go up, that means, in a sense, lenders provided you capital because you didn't have to pay it in cash. The section in yellow is often confusing to students, but just think about it in that way, that in the assets, in the operating activities, if the assets go up, you're using cash to buy those assets. And on the other side, if the liabilities go up, it's like your vendors or your suppliers are allowing you to use your cash on your own. They're providing you cash or the use of cash. That may not soak in immediately, but let that marinate for a while and maybe it will soon. The next section is on the investing activities. This represents cash in or out from investing activities. What are these investment activities? Here again, we have colors. The green represents purchases of securities or sales or maturities of those securities. Maturities refer to bonds, and we could sell a bond or sell stock. Those are obviously investing activities. Next are the ones in blue, and the most common one is additions to property, plant, and equipment, where we're buying new PP&E to grow or to replace old equipment. And the ones in yellow are additions for other purposes, like goodwill, where we acquire another company and we pay more money for that company than the fair value of the assets identified from that company. So extra money that we spent to buy that company is called goodwill. The other mentioned here as an investing activity is patents. When we need to use a patent that we don't own, we can approach the owner of the patent, negotiate a right to use the patent, and therefore that gives us a legal right to use it before the patent expires, and then we would then have that as an investment activity. Finally, the third section is financing activities. This is cash to and from capital sources, and that's again color-coded, where we have loans in green. When we increase loans, we get cash. When we decrease loans, we use cash. Blue is issuance of bonds. When we sell a bond, we get cash. Next is common stock. In yellow, when we sell new stock to investors, we get cash. When we repurchase shares, we use cash, and we see that in red. And the last item is the purple or magenta. That is payments for cash dividends, and that's using cash. A lot of action happens in this example related to financing activities. But I hope you see that the types of activities include small groupings of different moves the company can make. That's why you can tell a lot about a company based on looking at its cash flow statement. The statement of cash flows is very different from the income statement. Let's compare it. First, net income summarizes the performance of the company for the reporting period. It's prepared on an accrual basis. Revenues are recorded as earned, regardless of whether we got the cash or not, and expenses as incurred, again, whether or not we paid out the cash. The cash flow relates to the liquidity provided from the transactions. Cash and cash movements are the purpose of the statements. It looks at things from a very different vantage point than the accrual basis income statement. The cash flow statement summarizes the cash inflows and outflows for the reporting period based on the activities of operating, which is running the business, investing, which is for long-term assets, and financing, which are debt and equity transactions. And it assists the users of financial statements to forecast cash flows and outflows in the future. And particularly, it represents an understanding of how the balance sheet must move in conjunction with the income statement. Topic 3 is the introduction to financial statements and basic accounting principles. We have learning objectives of looking at the 5 statements of income statement, cash flow, comprehensive income, balance sheet, and shareholders' equity. And we also looked at accounting principles and the differences between book, intrinsic, and market values of the stock. There's a lot of takeaways in this topic because there's a lot of terms. Terminology and concepts. It's going to take a while for me to read 2 columns worth, but here we go. As I'm reading them, just read it and think about, do I understand what this is? Income statement, statement of cash flow, statement of comprehensive income, balance sheet, statement of shareholders' equity, gross profit, operating income, earnings before income taxes, also known as income before income taxes, net income, operating activities, investing activities, financing activities, unrealized gain or loss on bonds, unrealized gain or loss on investments that are available for sale, unrealized gain or loss from derivative investments, foreign currency translation gain, book value, intrinsic value, market value, equity valuation, historical cost, fair value, matching principle, timing, advertising, promotion, research and development, and mispricing. Questions you should be able to answer are: what information is contained in income statement, cash flows, comprehensive income, balance sheet, and statement of shareholders' equity? And what are the purposes of each of those statements, and what types of observations about the company may be made from each? Third, how does the cash flow statement change based on the company's life cycle? Fourth, what is comprehensive income, and how can we interpret the four components? Fifth, how are the financial statements linked to each other? Sixth, what are the differences between book value, intrinsic value, and market value, and how do these impact our analysis? Seventh, how do certain GAAP provisions appear to contradict each other, and how do these impact our analysis? And eighth, what are some items not measured on financial statements that may understate or overstate the market value of the company? There's a lot packed in topic 3. The cash flow patterns over time, when we looked at life cycle, show that when we're starting up a company, and you'll see it over here, when we're starting up a company, we'll likely have negatives in operating and investing because we're spending money to perhaps cover losses and to build our company by investing in the future. And we're borrowing or selling stock. A lot of financing is happening. As we grow, we may flip over and start generating cash from operating, but we're still investing in the future because we're growing. And we may still be dependent on adding to debt or equity to finance this growth phase. As we start reaching the peak at maturity, we're generating cash, we're still investing, but we're probably not necessarily needing more money for financing. We may in fact go negative by paying off some loans or paying dividends. And in decline, we may be milking the business to get a lot of cash from operating. We may be divesting of long-term investments, and that's why that's a plus. Or we may be minus in financing activities by, again, paying off debt or paying dividends or repurchasing shares. You see that the 3 activities are quite different, and it tells you a bit about the stage in the life cycle of a company. The connections between statements are illustrated graphically here. We see here the income statement, and it ties to comprehensive income because that's the beginning point for the statement of comprehensive income. The net income is then tied to the cash flow statement because it's a starting point for operating activities. The cash at the end of the cash flow statement ties to the balance sheet, where we look at the cash and cash equivalents in the current assets. And then the net income is found on the income statement, on the comprehensive income. It's tied on the cash flow and shows up in net income as a part of shareholders' equity. You see that all these statements fit together. Now, next topic is valuation and financial statements. What are these differences in values? First, let's make some observations. The book value of equity is found on financial statements as part of the balance sheet. Next is intrinsic value is the economic value of the company based on the future. Intrinsic versus the book are very different. Book value is a historical perspective. Intrinsic is a future perspective. Market value is what would somebody pay to buy the stock. Market value is established by the buying and selling of shares on an exchange such as New York Stock Exchange or NASDAQ. The historical cost is requirement under GAAP for many of the assets, such as property, plant, and equipment. And fair value is the market value of an asset or liability, which may be different than the book value or historical cost. And we see that prominently when we have a purchase transaction, like an M&A, which gives rise to goodwill. And here's some topics with some comments related to what we just covered. Cash and marketable securities. Well, that's a pretty good one, an easy one, because it's going to be very close to the market value as of the balance sheet date. Accounts receivable, it should be close as long as the allowance account was done right. Then it should be what we expect that we'll collect from the receivables. Inventory is less certain because we buy inventory at a lower cost than what we expect to sell it. We make mistakes, and therefore we may have obsolete inventory, but inventory will likely have value that exceeds the value found on the balance sheet because there's some embedded profit that we've yet to uncover or realize. PP&E is highly variable. It's recorded at historical cost, and it goes down from there based on depreciation. For certain assets like property, real estate property, it may go up in value. It may be wildly distorted for buildings. However, for equipment, it may go down faster than the useful life because of its obsolescence. This one's kind of can go either way. Goodwill, as mentioned, is based on what we pay in excess of the fair value for a company that we acquire. Unrecorded assets are things like people. We pay salaries to our employees and our management, but they're an asset to the company, and yet we don't see it on the balance sheet. Intellectual property, such as patents, copyrights, trademarks, are not on the balance sheet unless we pay to buy them from somebody else. Business contacts, R&D. We'll learn later that R&D is expensed immediately. We may spend billions of dollars doing research and development on a new cancer cure, but none of it shows up on our balance sheet because we expense it as we pay the R&D. And pipeline for future products and profit is not based on historical basis. More, it's based on the market attractiveness of our products. Mispricing is where the traded stock price differs from what the intrinsic value should be. And that is essentially an error in pricing where the markets had got it wrong, where the market value of the stock is significantly different from the true value of the stock. Example here being Enron, which was wildly overpriced and then collapsed when they fell. The fourth topic is Introduction to SEC Filings. And we looked at some of the roles and responsibilities of the SEC, some of the common filings for annual and quarterly, and some of the other special types of reporting when events occur, such as change in ownership or some other event. And then how do we access SEC filings? We go directly to EDGAR, which is a government database, or we find it in many websites and even the company's websites. It's quite easy to find financial statements. It's not really a secret. And a review of typical statements we looked at in this topic, which are 10K, proxy statements, and SEC comment letters. Takeaways on topic 4, SEC, equity market, bond market, National Securities Exchange, the New York Stock Exchange, NASDAQ, credit rating agencies, Moody's, Standard & Poor's, Fitch, Public Company Accounting Oversight Board, otherwise known as PCAOB, common forms such as 10K, 10Q, 8K, proxy, then SEC comment letters, and EDGAR's, which is that SEC database. Questions we should be able to answer are: what are the roles and responsibilities of the SEC? What are the major filings that companies submit to the SEC? And what can we learn from them? Specifically, the 10K, the 10Q, the proxy, which is a DEF 14A, and then the 8K. And how do we retrieve information from the SEC? We could try out some of our new skills on a real company called Snowflake, and it's a high-growth, high-profile tech company with an ambitious vision bringing together data storage, processing, and analytics solution across multiple platforms and partners. I know that sounds a lot of tech speak here, but it is quite an ambitious company that's trying to pull together many elements in technology. On the left, we see a chart that shows their business model of how they plan to bring together different sources of data and uses of data. On the right, we see the Snowflake and their trading price of $340. That is the market value of the stock. If we went a little further, we could see two filings. The first is an S1, and that's the filing before you're a public company. And essentially, it is a registration to become a public company. When Snowflake wanted to be an IPO and go public, they would first file the S1 that preceded their roadshow, which precedes the first sale of stock to the public. On the right is the annual filing that all public companies must file. It's the 10K. So on the right, we see Snowflake's 10K for the fiscal year ended 2021. This is the table of contents for Snowflake's 10K. And by the way, it's everybody's table of contents because this is prescribed by the SEC. The items in yellow, I'll just point out. The first is item 1 is the description of a business. Item 6 is select financial data, which is a quick way to look at key financial information. Item 7 is called the management discussion and analysis of financial condition and results of operations. And the short form is MD&A. And item 8 are the financial statements, the formal audited financial statements, which are the ones that are in compliance with GAAP. Number 1 is the business, and you'll see a brief description about what is the business of the company. Here it explains a little further about what is Snowflake's business. Item 6 is select financial data. You'll notice it doesn't provide full statements, just selected statements to give you an overview of the company. Here it shows key stats like their growth rate, pretty phenomenal, going from 96 to 264 to $592 million in 3 years. And their losses, maybe not as impressive. They went from losing 177 to losing 347 to losing almost $500 million. Growth came at a price. This is a typical high growth tech company that is hoping to gain a lot of market share and foothold. At some point, it flips over and starts making money. But here is losing a lot of money very, very quickly. MD&A shows the description of selected information that is given in the financial statement. And these are selected by management to discuss. It is not audited, although auditors do read it as a professional courtesy and part of their process, but it's not audited with any test work or field work. The next is the actual financial statements. Here's the balance sheet for Snowflake, showing again that they have substantial assets based on their IPO. And despite their losing a lot of cash, they still are looking at the end of 2021 at $800 million in cash and short-term investments of another $3 billion. They have quite a bit of cash and fairly readily marketable securities, totaling $4 billion. It's quite a war chest to grow their business or make acquisitions. We also see in the long-term investments another $1 billion in long-term investments, which may also be able to be liquefied and then used for growth. We also see some large increases in accounts receivable, almost going up by 50%, and in property, plant, and equipment, going from 27 to 68. In every regard, this company is growing very, very rapidly, but it looks like they have quite a few cash reserves based on the confidence that investors have in their business model. And if we look at the liability section of the balance sheet, we see their liabilities, which are fairly modest. And what's impressive is they've gone from 155 million to 6.2 billion. That was after the IPO. The IPO had them grow substantially in their equity base, going from a negative to almost $5 billion of positive equity. The IPO was quite successful. It gave them a lot of runway, as we call it, in order to take off. Income statement showed that growth we saw previously of roughly more than doubling each year, but it showed significant losses. And on the expenses, we haven't looked at it that previously. Gross margins are rising. If we did the math, we could see that it is now at 58%. Out of every dollar of revenue, 58 cents of that is going to cover the overhead and profit of the company. And R&D, this line right here, goes from 68 to 105 to 237. They are dramatically increasing their R&D expense, which is understandable because they're trying to create technology solutions that they will sell to their clients. And the losses are now, as we mentioned earlier, over $500 million. It's a bit of a race. Can they race and reach their flying altitude before they run out of cash? This is the shareholders' equity. This is kind of a daunting looking statement, but really it's not difficult. It just chronicles from top to bottom the changes in the equity for the company. And it provides all the moves in terms of stock, in terms of dividends, and other stock transactions. And the next is a statement of cash flows, which we know breaks into 3 activities: operating, investing, and financing. See here that the operating side is using cash, like 176 and now $45 million. But their investments are very heavy. They're purchasing investments in securities, but they're also growing in their PP&E, and they're also spending money on property, plant, and equipment. And in financing activities, again, we see in 2021 this very large $4.3 billion based on their IPO. And they did that, and they also issued some bonds to get even more capital. Those are the activities. They use cash for operating. They use cash, but now they're really investing cash in investing activities. And they're generating in this current year a lot of capital to then pursue their business plan. What did we just learn about Snowflake? They're a high-growth tech firm, and as one of the leading firms in data warehousing, they compete with Amazon, Oracle, Google, IBM, and those are pretty formidable, and also some smaller companies. They're by no means the leader of the industry, but they're trying to be. It has grown to over $500 million in revenues, and that's over 125% in 2021. And they have strong profit potential, as evidenced by high gross margins already. But it's operating a loss because of their costs of growing and their R&D expenditures. Snowflake went public in 2021, raised about $4 billion in cash, and most of those are just put into securities, using it in the future to pay for their growth. And this is a high-stakes, high-scale business. It'll be interesting to see if Snowflake can continue to stay on the top of this very visible and coveted market. The next section we're going to do in Module 4 is financial analysis using tools such as ratio and trend analysis. Now you've completed Module 3, shareholders' equity, cash flow statement, financial statement and accounting principles, SEC filing, and resources. And for a more detailed recap, again, look at that Word document in my courses. Up next comes Module 4, which includes financial analysis, ratios, trends, and common sizing, shareholder distributions, sustainable business, and a guided financial analysis project. One way to think about it is Modules 1, 2, and 3 prepare you to be in the position to read a financial statement like we just did for Snowflake, and more than that, prepare you to be ready to do some financial analysis in the next module. Enjoy!